The common stock portion would be 1,000. But if you sold those 1,000 shares to your shareholders at, let's say, $10 a share, you actually collected $10,000, right? But 1,000 was the common stock. The remaining 9,000 is called the paid in surplus. And you also have retained earnings. Sometimes it's called accumulated retained earnings. Every financial statement period, corporations announce a net income, right? Some of that net income they distribute it to shareholders as dividends, and some they don't. Whatever they haven't distributed is called retained earnings. Over time, this kind of accumulates. For example, let's look at this is balance sheet. This is NVIDIA, right? No, this is Google. Their retained earnings is $211 billion. That means ever since they were established as a corporation, which was, I think, 97 or 98, these guys were two PhD students in Stanford. Uh, they made $211 billion over and above any dividends that they have paid. I don't think Google has paid any dividends yet. So that's the entirety of it. And let me see. Says gross minority interest. Every once in a while, you're going to see a minority interest item. This is a product of the requirement that corporations need to consolidate their financial statements. If a corporation has subsidiaries, they do not issue, let's say there's only one subsidiary. They do not issue two different financial statements. They add the financial statements up. That's kind of done in order to prevent ways to, especially if that subsidiary is not 100% owned, in order to minimize the chances of, uh, you know, basically not taking advantage of the minority shareholders. This was very common in Korea. It still probably is going on right now. The Korean industrial system is centered around industrial groups called chobols. These are companies that are centered around one big mother. For example, Samsung is one of them. Probably the car company, Hyundai is another one. Let's give you and there's typically kind of a parent's family, the founder family, that owns pretty much everything. But they also have minority shareholders. Suppose I'm the founding family. I own 51% of Samsung, so I have control, but I am only entitled to 51% of the income, right? On the other hand, there is a subsidiary, let's say they produce car parts, but the family owns 100% of the car parts. And what they need to do is what they used to do. This car part company produces parts and sells them to, or let's call this TV parts in this case, sells them to Samsung. But they're going to sell it at a very expensive price. That means the profit of the subsidiary is going to be very high, but all of that profit goes to parent company or the founder's holding company. And Samsung is going to lose a lot of money. Let's say this excess they charge is $100. So the parents get $100. Samsung loses $100. You're thinking, no harm, no foul, right? No, because the parent company owns only 51% of Samsung. So they lost only 51. They lost 51 from Samsung. Net, they actually made 49. In a transaction that shouldn't have made any difference. Koreans actually have a term for this. It's called tunneling. They basically dug a tunnel from the 100% owned subsidiary to the holding company at the top. That means they stole $49 from Samsung shareholders. Because of that sort of stuff, companies have to consolidate. For example, the official name for Google, or the company that owns Google, I should say, is Alphabet. So if there are any subsidiary relationships, all of that has to be combined, and you have to show it that way. The trouble is, you have to add things up 100%, whether you own it 100% or less than 100%. So I'm Google. I own 51% of, let's say, YouTube. YouTube is not a separate company anymore, but if it was, I own 51% of that. And Google made $200. YouTube made $100. Consolidated, it's going to be shown as $300. But technically, it's 251 because I own only 51% of YouTube. The remaining 49 is called the minority interest. So it's written as a kind of a contra account. So if you see that, that's what that means. It's controlling interest, the values associated with controlling interest, that is not 100%. And let me show you one more thing before I kind of do a brief introduction to income statement. Uh, you remember our mother of all accounting identities. Oh, I'm sorry, I haven't talked about liabilities yet. Total liabilities are current liabilities. Come on. CL plus long-term debt. What we mean by current liabilities, these are obligations of the firm that are due within a year. So if you have a loan payment that you have to make in a year, that's a current liability. Or you have, among current liabilities, you have short-term debt, you have the current portion of the long-term debt, and these are not the interest payments. Sometimes you borrow $10 million, it's for 10 years, but you're required to pay 1/10 of the principal every year. So the 1/10 that is due this year is called the current portion of long-term debt. You have accounts payable. This is kind of the mirror image of accounts receivable. These are purchases you made from your suppliers, but you have not paid them yet. Again, within 12 months. These accounts payable and accounts receivable, if they are longer than 12 months, they typically also carry an interest amount. then they are called notes receivable and notes payable. And of course, you always have, long, and you always have other current assets, current liabilities. Among them, prepaid sales. You have a contract with a company. You're going to build them a power plant. Let's say it's going to cost $1 billion. They already paid you 500 million, but you haven't delivered anything yet. That is the liability because you have to produce that. But that 500 million, maybe in your cash, think of it this way. The company pays 500 million. It goes into your assets, but the things have to add up. So I have to create a liability. It's the prepaid sales or wages that accrued, but you haven't paid yet.